Hey, welcome to the Mortgage Minute for October 3rd. You can't tell behind me, but the sun is out, the sky is blue, and in Vancouver and October, that is rare. What's not rare is the fact that the headlines continue to talk about how sales are dropping and prices dropping, etc. Sellers struggle as housing prices slump in Vancouver. So we got housing, and of course, what's the culprit here? The mortgage rules. Tighter rules put squeeze on high-end homes. So what we're seeing again is a similar trend to what we've seen over the past few months. There's more and more talk about the slowdown in particularly the Vancouver housing market. And you know, it's like if you talk about something long enough, it's bound to come true. It's kind of like a broken clock still has the right time twice a day. So, you know, we're seeing this over and over. But let's take a look at some of the global factors that are impacting this. This was a headline earlier in the week, last week. In Spain, the misery grows. Get that up there, right? Really, what we're talking about is there's some major issues in Spain and Europe. This is not going away. You could go to my YouTube channel and go back 2 years ago, and I'm talking about Spain and Europe and the ongoing pressures. But what's interesting, that has, of course, the ripple effect that stalls Canada's economy. And here's an article that's saying that the stalling economy basically is handcuffing and tying the hands of Mark Carney. He can't raise rates, and that's a good thing for us. I mean, actually, speaking about rates, I had the privilege of seeing David Dodge talk down in Vancouver the other day. And David Dodge, for those of you who don't remember, is Mark Carney's predecessor, former Bank of Canada governor. And one of the things he talked about is that we still have excess capacity in the system. And as long as you have excess capacity and excess demand or excess capacity, then there is no upward pressure on it or inflationary pressure. In other words, there's no pressure on rates. Therefore, he says, that he doesn't anticipate this is going to change until 2016. Now make note of that. That's 2016. However, so in other words, a long period of sustained flat interest rates. You're probably not going to see much change in your interest rates between now and 2016, maybe 1 or 2 points. But he did say when it does change, the change could be swift and steep. So you have a flat line that'll just go boop, up like that. What does that mean? That means you may see a rise in rates in around 2016, and if you do, it could be 2 to 3%. What does that mean if you're taking out a 5-year mortgage today? What does it mean if you're coming up for renewal soon? Perhaps, if you're taking a 5-year rate today and it's going to renew in 2017, what environment are you renewing into? Perhaps, and I'm just suggesting this, maybe it's time to start looking at 10-year mortgages. Because think about that. If you get a 3.1% mortgage today and it carries through to 2017, but you're renewing into a 5 or 6% rate environment, and if you look at that as a whole 10-year frame and look at it, the price, how much is that costing you over 10 years? You could very well realize that it's costing you more money to do that than taking 3.9% interest for a 10-year mortgage today. In other words, a 10-year mortgage today, which is more expensive than the current 5, could end up saving you a lot of money over the 10-year period. Something very important that I think you should consider. And if you have more questions on that or other information and news, please let me know at peterkinch.com. That's the Mortgage Minute for October 3rd. Happy October.